Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He is the president and CEO of First Mining Gold, Jeff Swinoga. Thank you for joining me.
Thanks, Jason. It's a pleasure to be on your show.
Now, Jeff, you have over 25 years experience in the mining industry. So let's draw on that experience for our listeners out there and ask you about the state of the gold mining industry right now. So we're a little above $1,300 an ounce gold the time we're recording this interview on Thursday, May 3rd, 2018. So do you think in the last 7 years since the paper bear market started in gold that the gold mining industry in general, the producers of gold, have done a good job cutting costs?
Yeah. Hi. Well, with respect to cutting costs, I mean, what's happened is that gold had a run up, as you know, to about $1,900, and there was sort of a euphoric moment, and there's a lot of exploration money that went into finding gold, and there wasn't a lot of new gold deposits found, to be quite honest. And then when the gold price has come down and actually touched just above 1,000, large gold companies have not been investing into exploration. For the last 5 years, so there's been a real decrease in the amount of drills out there. There's a lack of large deposits being found. The majors are in a situation right now where they can't replace their reserves with what they currently have, and we're getting into a situation where if you look at the top 10 producers, there's going to be almost a supply deficit, if you will, for gold in the future. And in order to find more gold in geopolitical friendly jurisdictions, a lot of money has to come in and be invested by the major gold companies.
So when I've seen the press releases from the large senior gold miners, they have done a few acquisitions here and there over the years, but they're going and trying to buy future gold production where the potential mines are not economic now, where they need $1,400 to $1,500 gold at the minimum. And so do you in November, Jeff, I'm not sure if you saw this, but the CEO of Randgold Resources, and he's been saying this for a little while, so he hasn't been right in the short term, but long term, I think he's going to be right about this. He said that the price of gold is going to have a new price floor where there's going to be $1,400 an ounce gold. Otherwise, the gold mining industry, the producers of gold, are not going to be able to adequately replace, mine production, maintain production levels without them falling, and also economically replace mine reserves. So do you agree with the comments that the CEO of Randgold Resources has said in November?
Yeah, I think those are fair comments. I've seen that. I see it playing out in a similar fashion. As I mentioned, in fact, some of the large gold companies have been divesting of assets in terms of trying to reduce debt levels, increase their balance sheet strength, and now they're in a situation and not investing in exploration, as I mentioned. So they're in a situation now where their future production is depleting. They can't replace reserves. They will have to look at acquisitions, and they have done some acquisitions already, timidly, if you will. There's been nothing of a large scale yet, but they do need to acquire more reserves in the future. And to kind of keep a steady production profile, which is what they currently don't have. So, absolutely, I think that's certainly playing out in the mining sector right now.
So we're barely above $1,300 an ounce gold right now. Is the gold mining industry in general? Do they have good margins now, or do you think that they can tread water for a little while longer at the current prices, or do you think that the price of gold in U.S. dollars is going to have to go higher for the industry to maintain current production levels?
Yeah, to maintain a sort of a flatline production level, and going back to the CEO of Rand, I mean, definitely the gold price does have to rise. The margin that's needed, it's very difficult to find large deposits of gold, and in geo-friendly jurisdictions where it's mineable. I mean, the time frame to actually get a deposit up and running within 5 to 10 years is very difficult, depending on the infrastructure around that deposit. So even if there was massive investment in the gold mining sector right now in exploration, we'll still see that supply deficit. More production could come out of current mines with the with the gold price increasing, of course, because they just have to go after a lower grade, but that would mean costs would rise. So then you have a situation where the margin really hasn't changed that much. I mean, maybe it's increased slightly, but you have greater production, decreasing that deficit, as I mentioned, but you also have increasing costs with the rising gold price. So I would suggest that the number is probably higher than $1,400 in order to achieve a steady state production profile of some of these major gold companies. And even if they do acquisitions, there's how do they, basically when a large gold company takes over another company with a large resource reserve, they tend to do a lot of drilling because they want to prove it out. They want to see how large they can make it and, structure the mill at a certain size, because they can't go after small acquisitions. They have to go after very large deposits. So even doing that, it's not like they could buy something off the shelf right now and actually, solve their depleting production profile. So it will take time. And we're in the next 5 years, if something doesn't happen with a higher gold price or some technological change, we are going to see a supply deficit of gold.
Yeah, I've heard the CEO of Yamana Gold and other gold CEOs call this peak gold. It doesn't mean we're going to run out of gold. I think it's more a function of price. So if the prices don't rise, like you said, then it's just not going to be economically possible for the producers of gold to maintain the current production levels. So they're going to have to cut back. I think, for the last at least 3 or 4 years now, Jeff, and you could chime in if you disagree with me about this, that a lot of the producing gold miners have also high graded. So, in order to survive when the gold price did get to $1,100 an ounce gold, they did high grade their deposits. And, in the short term, that kept the company from going bankrupt. But in the long term, it could have potentially ruined the project economics of the mine.
Yeah, there's certainly pressure of high grading, and I've seen a little bit of that because when you have a situation where, again, gold going to $1,900 and then coming back down again to just above 1,000, gold companies who were planning to produce at a higher gold price now would have to shift gears, and you're in a situation where they'd have to higher grade to kind of recoup the capital or the investment they made at that higher gold price assumption in order to maintain their margins. These large gold companies, they need to attract generalist investors. And so generalist investors look at dividends, they look at margin. And so the ability of large gold companies to actually high grade to kind of maintain those margins, they would be under intense pressure to do that. And I've seen a little bit about that occurring after that, rise in the gold price. And so, I agree. And so in terms of going forward, there's a certain struggle to maintain current production. And what they've also learned is that volume is not always the key. So investors, when they look at gold companies, they want to see margin, they want to see cash flow, not just production. So you have a declining production profile of these major companies due to them trying to maintain margins on a per ounce basis, not just to be the largest producer of gold out there. So that's been a real struggle for them. And as you mentioned, when you high grade, you're leaving low grade, and that's the future, right? So that's another reason for the production profile decreasing.
Yeah, so it's worrisome, and a lot of experts are not talking about that right now, but beneath the surface, I think there's problems with the gold mining industry unless the prices do rise. So I think, like you said earlier in the interview, they can tread water. In terms of the all-in sustaining costs, though, when I look at the financial statements of a lot of producing gold miners, and some of these producing senior gold miners claim that they have like $800, $900 all-in sustaining costs, at the current gold price, that should be about $400, almost $500 an ounce margins of free cash flow, and yet I don't see those on the financial statements. So I think the all-in sustaining costs are more accurate than in the past with just cash costs, but I think they're still at least somewhat understating the real costs of gold mining.
Yeah, and when you look at these are all-in sustaining costs that are guidelines from the World Gold Council, and it really was sort of to understand the true cost of mining. By including other factors like corporate G&A and so forth. But when you look at the all-in cost, if you will, for mining, one thing that's not in all-in sustaining costs is our taxes and growth capital and growth exploration. So when a company is trying to maintain its production profile in the future, They often will look for satellite deposits that are outside its current open pit or current underground, and those costs to try and find that drilling costs, or to try and find those additional areas to mine to keep a production profile, they're not in the all-in sustaining cost. And taxes that are paid by mining companies are not in all-in sustaining costs. And growth capital to exploit a nearby ore body are also not in all-in sustaining costs. So when you're trying to equate the actual cash flow that's coming through in a mining company's financial statements, you're not going to equate it with all-in sustaining costs. You have to look at the overall cost of actually of mining and mining future gold.
And the average retail investor doesn't do this. I know years ago, Jeff, that on the investor presentations, a lot of producing gold companies would only put their cash costs. And governments in foreign countries and emerging markets where a lot of the tax revenues coming into a government were only, or the majority of it was mining, they would look at the cash costs and they would say, this mining company is immensely profitable. We're going to increase taxes on this mine. So the miners were not doing themselves any favor by underreporting the cost back then and only including the cash cost.
No, Jason, you make a very good point there, because you make it. You can look at an example of like Australia, right, where they had a windfall tax of 40% contemplated at one point, and the reason for that is because there was a misunderstanding, right? There was not alignment at what actually cash costs mean. And when you look at, to your point about looking at the margins that, or perceived margins that gold mining companies have in the past, it looked like exactly they were making more money than they actually were. So there had to be a realignment associated with that, where then all-in sustaining costs sort of came out of World Gold Council. Then you have all-in costs being contemplated. And even some large institutions are now calling it the all-enchilada costs, so that everything baked in, what is your true margin per ounce? And the understanding between the mining sector and as you mentioned, governments and other stakeholders had to be realigned. And I think that realignment is still going on, because, as you point out, a lot of people don't realize the difference between all-in sustaining costs and all-in costs or cash costs. So I think this sector has got to do a better job of educating people as to the cost of mining, and this is again going back to the point you made about why we need higher gold prices in order to for large companies, gold companies, to maintain their production profile, because they are not making as much money as they probably perceived to be.
Exactly. I would personally like to see the mining companies be even more transparent, itemize all your costs. So rather than just show, like on an investor presentation, an AISC number, itemize more of your costs, be more transparent with your shareholders. So if you do have a low cost, high grade, long life project, be proud of it. Show your costs, prove it. And so we don't have enough of that in the industry yet. The all-in sustaining cost is a lot better than just the cash cost in the past, but I think there's a lot more room to improve in terms of transparency.
Yeah, I agree.
So before we talk about your company, the gold market, there's things beneath the surface. So there is a lot of smart money now starting to gain more exposure of gold. Some of the big name investors like Ray Dalio, Jeff Gundlach are adding gold. And you told me before we started recording this interview that there was another really affluent Egyptian business owner who just started buying gold.
Yeah, Jason, this news just came out yesterday. I mean, there's the second largest, wealthy person in Egypt that is worth about $6 billion. He announced that he's putting half of his wealth, $3 billion, into gold. And what's quoted in the article is that he's looking at the geopolitical environment and the risks increasing worldwide, and he's making this long-term call. And the interesting part about this is that he's not someone from the sector who has followed gold, has made money in gold, and he's someone that has made his $6 billion actually through telecom. Through managing companies, acquiring companies, building, a telecom empire. And now he's taking half of his money that he has now made and putting it into gold. And he made it a public announcement. Of course, maybe he sees the gold price going up, and he wants that to be visible. But you're seeing it happen on a much more macro scale too. When you look at central bank buying, with China has been a consistent buyer of gold in the past couple of years. Russia is also buying; is a prolific buyer of gold. In fact, the Q1 report just kind of came out from the World Gold Council, stating that the biggest buyers were Russia, Turkey, and Kazakhstan. And of the net buying from central banks, I think Russia represented about 35%. So it might be a play on the fact that they're expecting the U.S. dollar to devalue. It could be the diversification, but to be that focused on buying gold, as well as you mentioned, this wealthy investor coming out and doing this, there certainly is a lot of positive pressure that's going to be placed upon the gold price in the future.
Yeah, I think it's putting a strong price floor. There's strong buying demand in gold. So whenever the gold price does drop, it seems there's strong demand for gold. So the gold price in US dollars has not broken out yet, but it looks like it's also not going to crash anytime soon, because anytime it dips, there is strong buying support. I think the other reason that a lot of big money is starting to get gold exposure is that there's been a lot of extra volatility now, really, since the year started in stocks and bonds. So any type of volatility up and down means that people are not, it's not easy money to be made in stocks anymore, and people who have already made a lot of money in stocks are going to be rotating their profits into gold. So that's what, from what I talked to with professional money managers, that's what a lot of them are starting to do. They're looking at gold now after having made a lot of money already in stocks and bonds since the central banks reflated everything 10 years ago.
Yeah, and I agree with that, Jason. If you look at gold's past, and I joined Barrick Gold back in 1998, and gold was $260 an ounce, and everyone, not everyone, but a lot of analysts thought that gold was going down to $200 an ounce. And back then everything was going kind of virtual, right? Mining companies were converting to internet incubator companies, and everyone thought it was a mistake joining Barrick because everything's going virtual. And gold basically doubled in a couple of years following that, right? So gold has been volatile itself, but it's been, if I like to characterize it as positive volatility. There's been an upswing in gold over the last couple of decades, and it has been volatile, but it's been a positive trend. So what we're seeing now is a lot of, if you will, smart money or macro money that have access to a lot of sophisticated models and advisors actually buying more gold. Because I think they do believe there's going to be a breakout in the gold price.
And I don't think, Jeff, that there's any more $200 an ounce economic gold anymore. So there's like deflationists and bears out there saying the gold price is going to crash and go a lot lower. But I don't think there's really any more economic gold left at those prices.
No, and people, honestly, I don't know if people realize, but gold is very scarce. I mean, all the gold above ground, I mean, you could put into an Olympic-sized swimming pool. 21 meters cubed basically is what, and so people see it on the rings and necklaces and so forth, but it's a very scarce metal.
Exactly, and gold is recycled, so it's kept above ground. They spend more time recycling the gold and finding it more than silver. Silver, a lot of it ends up in landfills. So let's transition now to your company. Before I start asking you questions about your company, there's a free in-depth research report available for our listeners out there who want to go do more comprehensive research on your company, First Mining Gold, at futuremoneytrends.au. You have one flagship, one major in your tier one group of assets. You have this Springpole project. You're moving it along towards production. If this was a private company, can you explain how profitable it would be to put Springpole into production for shareholders?
Sure. And Jason, let me just step back for a second, if that's okay. I mean, the genesis of this company and how it was created, Keith Neumeier is our founding chairman, a tremendous individual. He was one of the founders of First Quantum and also CEO of First Majestic. Him and the team rolled up about 25 properties in a very low gold price environment. And now I was hired about 3 months ago. I like building projects. I've got a deep experience with respect to that. And so the strategy has changed to start advancing some of these properties And as you mentioned, the one big one we have is called Springpole. It's got 4.7 million ounces of gold, basically 5 million ounces of gold in Ontario. It's considered one of the largest undeveloped gold properties in Canada, if not the world. It's tremendous in the sense of when you talk about economics and being a private company. We just did a recent preliminary economic assessment on Springpole, and the net present value of Springpole after tax is about $800 million US, or about $1 billion Canadian. So that just shows that this is a sizable deposit. The IRR after tax is over 26%. It's got potential to produce 300,000 ounces per year for about 12-year mine life. Low payback, under 4 years. So it's what they call sort of a big boy or big company project. And you know, for my 7 years at Barrick and Hudbay and North American Palladium and Torex, I mean, any one of those companies would be happy to have a project of that size and magnitude in their portfolio. So I feel very fortunate to have Springpole, but also we've got 3 other properties in Ontario, all we call Tier 1, all gold. We have one in Newfoundland as well called Holbrook. So we've got a real good foundation. And the vision here is to create a mid-tier to large gold producer in Canada. Again, this is in Canada. This is not in South America or Africa or Russia. I mean, Ontario and Newfoundland are some of the best mining-friendly jurisdictions to do development and mining, and so we're very, very fortunate.
And one last question on Springpole: how long before? What's the timeline for production right now?
And that's a great question, Jason, because what we're doing is we're really educating all of our stakeholders, investors on the plan and what we plan to do for. I'm very big on building intrinsic value. So we're looking at having first gold within about 5 years. We're going to go through the environmental assessment process, and that's already been kicked off. It's going to take 2 years, go through permitting, construction, and then first gold in 5 years. So, I mean, that's a relatively aggressive timescale from when you look at a global scale on how to produce gold from a deposit. But we're very far advanced. A lot of drilling has already occurred. We've got lots of data. We don't see any red flags with this project. I think with our experience and the great technical team that we have over 30 staff members. So we're very motivated. We're very focused. We're putting a lot of systems and processes in place to make sure that we're successful and not lucky. So it's very important for us to do this and do the hard work and then talk about it to investors.
And by waiting about 5 years, you may even have a lot higher gold price. Absolutely.
No, I think it's. I think gold's going to break out sooner, of course, but we'll be in a very favorable situation. And this deposit is very attractive. When you look at our market capitalization, it's about $300 million, and we've got $1 billion project, just one of our projects. So you can see that there's a bit of an arbitrage there. So for our goal here is to unlock the value, de-risk the asset, build intrinsic value. Our share price is already responding. We were in the 40-cent range. Now we're in the lower 50 cents range. So we're getting traction with investors as we educate them. We're coming out with new video showing the project and how we intend to develop it. So there's going to be, I think, a lot more eyes on Springpole going forward. And we're creating that visibility, and we're clarifying how we're advancing, developing this project for the benefit of shareholders.
So in your Tier 1 assets, I noticed that they're in Canada. Is there a main reason for why you chose to be in Canada and specifically in Ontario? Is it more friendly to mining? Are you worried about even if the grades may be better in some of those other countries that you mentioned, that the geopolitical risk just isn't worth it?
Yeah. In sense of with respect to location, again, Ontario is a great place to develop a mining deposit. Great infrastructure, relatively straightforward permitting process. Other places around the world to develop deposits, there's a myriad of issues. I've helped develop deposits in Africa, South America, and there's cultural, there's time differences, there's things that it's very difficult. I could go on for a long time talking about some of the things I've seen, And this is why I feel very excited and fortunate to be working on assets in Ontario. And the reason they're in Ontario is because when Keith and the team were rolling up these assets, we do have assets in other jurisdictions, but these are the biggest and the most logical, and again, best jurisdiction to be developing these deposits.
And it seems, Jeff, you have more experience than me, but I've looked at thousands of presentations for mining companies, and in a lot of different countries, the geopolitical risk can change almost at a whim. For example, look at Tahoe Resources and their world-class Escobal Silver project. The tax rules can change in that regard. Tanzania, I think, in the last year or so, drastically changed the rules on their gold miner, and they want a very large chunk of the revenues that any of their gold miners produce. So now the gold miners that have operating existing mines are no longer profitable. So I guess, when you go to Canada, the rules aren't going to change that quickly then, right?
No, that's right. And the challenge is I worked on the Bulyanhulu project, at Barrick when in Tanzania, we talked about Tanzania, and then also the DRC. I mean, the royalties they're putting on mines, making them unprofitable or making them extracting all the profits, if you will. And then again, you look at Mexico and Guatemala and other areas. It's very challenging, and it's difficult to understand when you're making long-term decisions, when you're building and advancing a mine or a project. How you're going to protect shareholders, right? And because they deserve that return when they buy shares in a company. They invest because they want to earn 26% or whatever the number happens to be. So being in Ontario with clarity of framework and environment and permitting, it's again maybe I guess because with all my experience and what I've seen, I'm actually very happy to be in Ontario. So there's certainly lots of war stories I can get into. Old stories, not war stories, but it's again if you don't know, I mean, Ontario, Quebec, and Newfoundland are just great places to be in terms of developing projects and mines.
So before I started the interview, I went to CanadianInsider.com, which is what you can, our listeners can do for research to go and look up the insider purchasing of shares for free. And since January, you and Keith Neumeier have been buying quite a bit of shares on the open market. So why are you guys buying more shares on the open market in the last couple months? Do you think your company is extremely undervalued? Do you think the market has drastically not seen something that is important? Do you guys have more catalysts coming in the near future that you think the market is missing out on?
It's I've a couple of things there that you mentioned. One is I think any senior management of a company should be aligned with shareholders and should own a significant amount of stock. What I'm doing is I'm putting my first year salary into the shares of the company. So in buying on the open market, much like other shareholders would. So I think that's very important. So far, I've bought 142,000 shares, and I'll be continuing to buy this year. Keith is already a large shareholder in the company, and he's continued to buy alongside me. Of course, he's bought more. We're aligning ourselves with shareholders, but also I really believe in this company. The reason I took on this job is because I believe these assets the value can be unlocked. I can advance them with the team that we have. Again, we've got 30 staff members, highly qualified, highly motivated, and I think we have the makings of another large producing gold company in the makings here because we've got the foundation. We don't have to go and acquire projects. We already have the projects. So, in fact, the work that we're doing is not necessarily difficult work. It's just there's work to do. So, again, advance these projects, unlock the value, educate shareholders and other stakeholders how we're going to do it and how we are doing it. We've done in the last 3 months. We've done a tremendous amount of work. We've delivered. We kicked off the federal environmental assessment process. We've done a lot of studies have already been started, initiated, and there'll be news items out on those too.
Very exciting. Now, earlier in the interview, you talked about valuation for your company and why you think your company is undervalued. So according to your newest presentation on your website, which I believe was released in March of this year, that in a peer-to-peer comparison, you're 71% below the average in terms of enterprise value divided by ounces of gold. What do you think needs to change for the market to revalue, re-rate First Mining Gold to the mean or average of your peer groups of near-term gold producers?
Yeah, and that's the advancement we're talking about. We're talking about there's two things. One is advancement. One is education, and understanding our assets better. On our presentation, you'll see a number of new slides that we put in there to talk about our assets and the value of our assets and how we're going to mine our assets in the future. So it's really in education. We've already again started seeing traction. We're in the 40-cent range now. We're in the 50-cent range. So, and I'm hopeful that as we create that intrinsic value, as we de-risk these assets, especially Springpole, the big one, that we're going to see our positive pressure on our share price. Again, market capitalization of $300 million right now, and Springpole alone is about $1 billion in Canadian net present value after tax. So you can see that there's a lot of runway there for us to move up.
Now, but besides yourself, for our listeners who are not familiar with your company, can you talk about the rest of the management team and why you think you have a good management team and maybe any advantages that you might have inside your management team compared to other companies?
Sure. I already talked about Keith, and how it's great to work with someone of that caliber. I mean, it's a tremendous individual. On the other staff of my COO is Chris Osterman. He's a PhD in geology, extremely smart individual, focused as well. He's supported by Bill Tanaka, mining engineer with over 20 years experience working on resource estimates, mine plans, and so forth. He's a tremendous person to work with. And then we have our staff, our CFO, chief legal, and so forth. And we've got over 19 people in Ontario, 4 really key people north of Thunder Bay who are going to be the spear tip of success for a lot of these projects that we're developing, especially Springpole and Goldland. There are guys on the environmental side. We've got someone who's got 30 plus years experience, who's done this before, who knows the regulators, who knows local communities. We have a great person working on Indigenous relationships and local communities as well. Again, 35 plus years experience with him. So there's 4 guys, each of them with over 30 years experience, combined about 130 years of experience developing projects. So we have a very focused team, and they're supported by others, of course, that will help them out as we embark upon the de-risking aspect of these projects. So we've got a really good team. I mean, we don't have a couple guys in the head office. We've got a lot of people in the field, 30 plus staff members in total, and we're very happy.
And also, this is not the first mine or company that you're building. So some of these juniors out there may have a good project, but the management team, they may have worked for a few years at a larger mining company, and maybe then they're trying to go out on their own for their first mining venture, but this is not your first rodeo.
No, and the key here is we're conducting ourselves like a large company because we want to create a large company. So we're very systematic, we're very process oriented. We've adopted a culture with what we call the values culture. So all the things that you want others to be successful, we want us to be successful. For example, honesty, integrity, respectfulness, caring, fairness. All those things are very important in our communication strategy and our decision making because we're looking to build long-term trust with Indigenous and local communities around our projects. And when you're building projects and you're building a company, you need to have that trust. And we're going to be building that trust, and it's going to be a great journey for all of us at the company and all of our investors. And we're also very purpose-led. We want to make sure that we're very much focused. We can't be all things to all people, and we do work for shareholders, so they deserve the return that we're going to provide them. But we're building frameworks, systems, and processes to be successful.
And you'll have to come back on in the future and give our listeners updates about your company as you progress towards your first producing gold mine. Keith Neumeier, I've been following his work for a very long time, about 10 years since I got interested in gold and silver. I've interviewed him many years for my channel. Pretty much, Jeff, almost everything Keith touches turns to gold or silver. He's just an experienced, hardworking, smart company builder. He built First Quantum from the ground up. He built First Majestic Silver with smart acquisitions when everyone hated silver. So he just has a very good track record of figuring out ways to build successful companies in the resource industry.
Yeah, and Keith is, again, a very fortunate to work with a person of that caliber. With his experience, definitely we have great conversations. I've seen the hard work that Keith has put into his companies and how he's really helping out at First Mining Gold. So I can't speak enough about Keith, and he's very much focused, and all the things we're doing at First Mining Gold, he certainly he shares that enthusiasm and shares our excitement about how we're doing things, and he's very much committed, as you mentioned, about purchasing shares, more shares than me, actually, in the last couple months.
Yeah, I really respect insider purchasing of shares on the open market when the executives put their money where their mouth is. I don't like a lot of these New York Stock Exchange large corporate executives who just, play the financial engineering game to make goose earnings higher, to get stock option bonuses, and then they don't put their money where their mouth is and go and buy any shares on the open market. I really don't like a lot of executives like that. I don't trust them either.
Mm-hmm. Yeah, no, I think it's any management senior member needs to show that they're aligned with shareholders, and I think it's just common sense to do that. So there's always the argument that you need to attract good talent, but I think good talent needs to demonstrate they're committed, and this is what I truly believe. Yeah.
Well, Jeff, I want to thank you again for your time today. Again, I'll repeat this for our listeners out there. If they want to download a free, comprehensive, in-depth research report, they can go to futuremoneytrends.com/AU, like the symbol on the periodic table of elements for gold, for an in-depth research report on your company for free. Or they can go to your website, Jeff, which is?
Yeah, firstmininggold.com.
Great. Well, I wish you guys the best of luck, and it sounds like you guys have a more than capable management team, and you're going to be moving this thing forward very efficiently.
Yeah, thanks a lot. Yeah, thanks a lot. Yeah, thanks a lot, Jason. It's a pleasure being on. And again, I love talking about what we're doing because I think we're doing all the right things, and look forward to a follow-up conversation.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone despite YouTube censorship, and hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.